Greetings, everybody. Welcome to Liberty Call. Today is Tuesday, March 27th, 2023. Hope everybody's having a fantastical day out there. It's a beautiful day here in Colorado. We had a second winter yesterday. So we got a little bit of snow, not too deep, but most of it is melting off, thankfully, although probably not in my backyard because it doesn't get a lot of sun. And, I've been trying to clean up the dog mess that gets left there after the tundra melts away. And each time it starts to dry out, we get more snow. It's like, I guess that petrified poop's going to stay there for a little bit longer. Anyways, if it's your first time watching the Liberty Call, I know you didn't come here to hear me talk about snow and dog poop. Please give me some big old thumbs up, like, share, subscribes. I would greatly appreciate it. Not the worst day today, but looks like technology took it, pretty decently in the teeth today. Rest of the world, not too bad. See good amount of green throughout the trading day. So let's go ahead and jump in over to the indexes and see how they turned out today. Dow Jones was down 0.12%, 37 points, or closed at 32,394. The S&P 500 was down 0.15, or 6 points, closed at 3971. NASDAQ down 0.45, closed at 11,716. The VIX fell 3.06% today. It's currently at 1997. Canada up 0.17, Brazil up 1.46%, Mexico up 0.71. Headed over to Europe, Germany flat, up 0.09, UK up 0.17, France up 0.14, Netherlands down 0.29, Spain up 0.43, Italy up 0.47, Switzerland up 0.49, Portugal was up 0.92%. Russian exchanges were split today. The MOEX, but basically flat, up 0.06. The RTSI was down 0.21. The overnights in Asia, the Nikkei in Japan was up 0.15. Australia up 1.04%. New Zealand up 0.95. In the Chinese markets, the Shanghai was down 0.19. The Shenzhen component down 0.72. China A50 up 0.19. DJ Shanghai down 0.29. Hang Seng up 1.11%. Taiwan weighted was down 0.81% for today. All righty, let's go ahead and move on over to today's market recap. SP 500 dips on tech drag as yields rise on easing bank jitters, upbeat consumer. Let's see what all that has to do with. On Tuesday, the SP 500 slipped as big tech stocks continued to stumble amid rising Treasury yields while worries about a banking crisis eased. Treasury yields increased further from the previous day, buoyed by consumer confidence data that suggests the Federal Reserve may need to continue its hawkish policy guidance. The Consumer Confidence Index rose to 104.2 in March, exceeding economists' forecasts of 101. As a result, Jeffries noted that the confidence data suggests that the Fed needs to push forward with its hawkish policy guidance. Meanwhile, tech stocks, particularly big tech, remained under pressure due to the rising rate environment. Apple, Meta, Alphabet, and Microsoft all fell by over 1%, with the latter under regulatory scrutiny as Germany's antitrust watchdog investigates whether the tech giant's market power may warrant an investigation into potentially anti-competitive practices. The dip in semiconductors also weighed on the broader tech, with Micron Technologies Inc. Results expected to reflect lower demand for memory amid a soft backdrop for cloud and PC, while elevated inventories remain a drag. On the other hand, energy rose by more than 1%, particularly offset by the broader market losses, with Occidental Petroleum, Valero, and Phillips 66 leading to the upside. Warren Buffett also increased his stake in Occidental Petroleum to 23.6% after buying 3.7 million shares of the oil major in the past 3 days, according to a regulatory filing. Alibaba, meanwhile, rose over 13% after announcing plans to split the business into 6 units, with each able to raise outside capital, including via initial public offerings. Walgreens gained 2% after reporting quarterly results that exceeded Wall Street estimates. In other news, Lyft reversed gains after David Risher, who was appointed the new CEO and set to take the helm on April 1st, ruled out the sale of the company. Risher said that Lyft wasn't for sale and would be focused on its ride-sharing business. However, some remain uncertain whether Lyft will be able to make up ground against larger rival Uber. Deutsche Bank noted that while Risher is expected to take a fresh look at Lyft's strategic direction, cost structure, and go-to-market strategy, it remains unclear if new management will be sufficient to counteract some of the durable advantages Uber has within the U.S. rideshare market. All right. Well, that's everything there as far as the daily recap. Drilling a little deeper, U.S. Consumer confidence rises as Americans shrug off the bank failures. I don't know if they're really shrugging off bank failures other than just waiting for the next shoe to drop. Despite the recent financial market turmoil that has led to the collapse of two regional banks, the Consumer Confidence Survey from the Confidence Board showed that U.S. consumer confidence unexpectedly increased in March. According to the survey, more consumers plan to buy household appliances such as refrigerators, washing machines, vacuum cleaners, and television sets over the next 6 months, although consumers showed inclination to cut back on discretionary spending, including lottery tickets, amusement parks, going to the movies, and dining out. They intended to increase spending on healthcare, home and auto maintenance and repair, pet care, and personal grooming. The survey suggests that consumption could continue to grow at a moderate clip and keep the overall economy afloat. I don't know. I think it's probably going to collapse. But hey, these geniuses that work for all these think tanks, they seem to know everything. They're usually wrong, but we'll humor them. They seem to think everything's going to be fine the next year. However, Americans continue to expect inflation to remain elevated over the next year. Consumers' 12-month inflation expectations rose to 6.3% from 6.2% last month, indicating that the Federal Reserve would continue to fight against inflation by increasing its benchmark overnight interest rate. Although the job market was tight, the share of consumers viewing jobs as plentiful fell, while the proportion saying jobs were not so plentiful rose. The share of those saying jobs were hard to get dipped to the lowest level since April of 22. Consumer plans to buy a home over the next 6 months were unchanged in March, and housing affordability, which deteriorated as mortgage rates surged in response to the Federal Reserve's fight against inflation, is starting to gradually improve as home price gains continue to moderate. Although the housing market appears to be finding a floor, the trade flows are weakening, with the trade deficit in goods increasing 0.6 to $91.6 billion in February. The goods trade gap for the first 2 months of this quarter is slightly above the October to December quarter levels. Despite the overall decline, the imports of motor vehicles and parts tumbled 7.1%, while those of consumer goods dropped 5.6%. All right, well, it seems like the consumer, via a survey, seems to think things are doing a little bit better. I don't know. Maybe because I know how the sausage is made. Maybe I'm just a little more skeptical of how things are going right now. But hey, I could be wrong. I'm not perfect. All right. Last article here comes from our friends over at the Mises Institute. Is the Fed trying to bail out the world? Sure looks like it. This was written by Christopher Mouston Hansen. All right. The collapse of Credit Suisse, one of Switzerland's largest banks, was a catastrophic event that had been brewing for a long time. The bank experienced a classic bank run as depositors withdrew their funds, which caused Credit Suisse's liquid assets to decline by more than 50%, from $229 billion to $118.5 billion. This decline in assets had little to do with the collapse of SVB, but had everything to do with the contraction of the international monetary system. The Federal Reserve has long pursued a deflationary policy that involves sterilizing bank reserves by accumulating reserve repos. These repos allow banks and financial institutions to move their cash into the Fed and earn a cool, risk-free 4.8%. However, not all banks have access to these repos. Only primary dealers and accepted reverse repo counterparties can conduct business with the New York Fed. The international aspects of these banks is one of particular interest, since it is the markets of these international banks operate in that have been drained of dollars due to Fed deflation. Mainly the euro dollar system. Euro dollars are simply dollar deposits originating outside the United States and not subject to U.S. regulations. They have played an increasingly important role in the international financial system since the 1960s. The euro dollar banks operate on a fractional reserve basis, and if you've been playing along, fractional reserve banking has worked out so well for us since the Fed instituted it back a little over 100 years ago. Where was I? Where'd I go? I lost my spot. Reverse repos, dollar appreciate 96 throughout 2021. Investment banks to international borrowers. Don't you hate that? Fractional reserve basis. If reserves are cheap and plentiful, they expand, and if reserves become expensive and scarce, they contract. The ultimate supplier of reserves is the Federal Reserve, either directly through related international investment banks or indirectly through U.S. banks that supply credit to international borrowers. The rapid appreciation of the dollar throughout 21 and 22 suggests that there was a significant contraction of the euro-dollar supply. This contraction also compares well with changes in reverse repos. The dollar appreciated continuously to almost 96 cents per euro in late of September of 22, only to depreciate rapidly thereafter, while reverse repos reached a peak of 2.4 trillion on Friday, September 30th, and have fallen significantly since. The Fed's contraction ended in October of 22, after which no talk of tightening was connected to the reality in the international dollar market. It is essential to note that the change in Fed policy came at precisely the time that Credit Suisse felt the squeeze in October of 22. While the change in policy was not entirely driven by the Fed, the credit contraction would drive up interest rates in the market, making it attractive to move from reverse repurchases to expansion private lending. As credit tightened for Credit Suisse, Swiss bankers would pay dearly for short-term loans to fund the outflows of deposits and avoid illiquidity and bankruptcy. However, that can only explain the short-run change in flow of liquidity. The turn in loose money in October was a deliberate policy change aimed at propping up the euro-dollar market. All right. Well, that's everything I had to cover for today. I know that was kind of a dry article, but is what it is. If you'd like to read through it at your own leisure, it is attached in the show notes. That's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening. And if you need anything from me, please just reach out. You can reach me via email, phone, or smoke signals. Anyways, all right. Hope everyone has a great night, and I'll talk to you next time. Adios.